Good afternoon and welcome this Friday afternoon to Market Movers, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. And that was the bell, which means that the market is closed for this week and this month. And we're 2/3 of the way through the first quarter of 2025. Wow. Crazy, crazy movement today. We'll talk a little bit about that and we'll get into this discussion. Today, I am joined out there in the chat by my good friend Brent Moores, education coach, senior manager, 20-plus year veteran of the financial markets. Great guy. And by the way, he's going to be teaching this next Friday for me. And I'm going to be in Scottsdale, Arizona, which I hope that some of you are going to be there as well. We're going to be doing the technical analysis and options strategies live workshop Friday and Saturday from the Phoenicians. So we will jump into that and we'll talk a little bit about those events here in just a moment. But a couple of quick housekeeping items before we get started with this rundown of the course of the last week. And boy, I'll tell you what, Kenneth, we'll try to put an explanation to what has been going on, but you never know. The market is a multivariate dynamic system. So let's take a look at a couple of quick housekeeping items, though, before we get started. Remember, everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation or personalized investment advice. It is not a solicitation. Make sure that you understand what's going on out there in the market. Make sure that you do your own research and due diligence about anything that you consider investing in. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. There are a lot of different ways to look at the market: technical analysis, fundamental analysis, intermarket analysis, probability analysis. All of them are theoretical in nature. None of them are guarantees as to what the market is going to do. And none of them are guarantees as to an explanation of what the market has done. But in light of that, Schwab doesn't recommend the use of technical analysis as the sole means of investment research. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that. It's a great sandbox to learn. It is not, however, a guarantee of future success out there in the real world. So be aware of that. Remember that past performance, no guarantee of future results, and all investing involves risk, including the loss of principal. Now, one quick note: if we do happen to look at illustrative examples, we may talk a little bit about stop orders. Remember that stop orders don't guarantee an execution price. They simply allow us to specify an activation price. So we're going to talk about the market kind of in this sense. For those of you that have been here with us before, you know we spend a little bit of time kind of casting our eye around the market, doing some comparisons. We take it from kind of a macro approach and then focus our efforts then down onto individual symbols. So we're going to take a look at the general trend, what moved markets, how were portfolios impacted by that. We're going to take a look kind of at some of the over the horizon ideas and events that might be coming, because that's maybe kind of that look forward at what's going on possibly next week, something to pay attention to. So as we do that, I'm going to go ahead and I'm going to switch over to the Thinkorswim desktop software platform. And once again, thank you to all of you, whether you're here on a regular basis, whether this is your first time here. This webcast is being recorded so that you can come back and watch this at a later date. And if you have comments, please chat those in. If you have questions, please chat those in. That's what Brent's here for. If you're watching this in the recorded version, you can still participate in the conversation by leaving comments in the comment section. Now, as I jump into the Thinkorswim desktop software platform here, good reminder to click on that subscribe button down at the bottom of the page if you have not done so already. And that's going to connect you to that Trader Talks webcasts community. It's a no-cost subscription to you. If you haven't already done so, click on that subscribe button down at the bottom of the page. Also, if you like today's webcast, click on the like button. That's going to pop it up in the algorithm and maybe bring it to the forefront for other people. But here we are. with the SPX. And this might be as good a place to start this evaluation of what's gone on this week as any other, as I normally start by saying it's been an interesting week around the markets, a little homage to Garrison Keillor and Prairie Home Companion. But taking a look at what's gone on today is, again, one of those days where one of these things is not like the others. Over the course of the last week, we see a bit of a big green candle today, potentially off of a level of support. Now, there are a couple of things that I noticed over the course of this week. One, we broke the 50-period simple moving average. Two, we came down and in the intermediate term, and intermediate term in this context is weeks to months. So looking back over the course of the last 2 or 3 weeks, we made a new lower low. So we could probably make the argument that in that context, we have been in a short to intermediate term downtrend. Now, the other thing that I happen to notice, two other things that I happen to notice, is that we've not yet made a new, at least on the SPX, we have not made a new lower low on the long-term trend. The long-term trend is still intact in this particular case. We have not, and we just say that again, the SPX has not made a new long-term low. Even as bad as the previous days over the course of this week seemed and were in some cases, the trend has not changed. The long-term trend has not changed. We have, however, gotten a little bit closer to that 200-period moving average. And I'm not saying that by any means that this was a positive week. We saw a little bit of buying pressure coming in here at the end of the day today, which lifted markets into the end of this month. And a lot of that maybe is rebalancing at the end of the month. A lot of that is maybe covering short positions going into the weekend to perhaps eliminate some of that overnight and over the weekend risk. These geopolitical events happen at any time. But the trend is still intact. The 200-period moving average still moving higher, even though the 50-period has started to roll down a little bit. And the other thing that we notice here is the RSI never went all the way down to that oversold line, even as much as that push was on to the downside. And I attribute that to a couple of things. I attribute that to kind of midweek. These candles early and then midweek had some lower lows. And you remember that the RSI, in this particular case, the RSI, the Relative Strength Index, functions by looking primarily at where price is closing relative to the highs and lows. So if we have a longer shadow or wick to the downside and then price comes back and we get a hammer candle that gets generated, that's not going to print as low on the RSI as if the candle closes near the low. So we had a couple of those kind of hammer-like candles midweek, into midweek. Yesterday was a close right down smack on the low. Today was a close right almost up on the high. And so we see this turnaround in the RSI. And it didn't really push back in that range. So, you know, we can look at this from a lot of different perspectives. And we can say, wow, it seemed really bearish this week. We can look at it from the perspective of saying, well, with objective evidence, the trend line is still intact. We could draw lines going back into September of last year, and we're right along that diagonal trend line, right? And Trade and Grow just pointed that out in terms of where that level is, and we can draw a whole bunch of different lines here. But nevertheless, the SPX came roaring back this afternoon. If we look at this on the intraday basis, so we kind of shrink our time frame down here. So we're going to click on our time frame icon here at the top of the chart. We're going to take this down to a 1 day, and I'll take this down to a 1 day. Actually, we'll take it down to a 5-day, 5-minute chart just to kind of see what's gone on. 5-day, 5 minutes. So each one of these candles represents 5 minutes of trading over the course of the day. So you can see when that started. It was after lunch. Traders came back from lunch midday today and came after those prices in a big hurry and to a great degree. In fact, pushing back up to above the high and right up against the high of yesterday, right? We can see where that resistance area is right in this particular range here at the 59.61 mark or so. And we can see in the intraday chart, in this 5-day, 5-minute chart, that big push to the upside to that extreme, up into that overbought range on the RSI on the short-term candle. So definitely some bullishness coming in at least late in the day. In the last two 15-minute candles, or last two 5-minute candles of the day were the biggest of the day, with the exception of this one coming up off of the bottom. So coming into the end of the day with a lot of momentum, ended the day with a lot of momentum, and that was the SPX, at least at the moment. So Kenneth asks a great question here. And without getting into option strategies, remember we talked about that, right? So options are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options. We're not going to look at specific options in this discussion, but the question is, how do options react to this kind of move? This kind of move to the upside can change option prices significantly, especially close to expiration, simply because of gamma. If you want to learn more about that, I'll show you some resources, and we can talk a little bit about that as far as those resources are concerned, but I don't want to get into specific ideas here. So let's jump back to our daily chart. We'll go back to our that's not our 1 year daily chart. That's our 1 year daily chart. We'll take a look at the next one in the grid, which is the NASDAQ, which arguably had a much more significant downward push, came closer to the 200 period moving average, and in this particular case did create, if you want to look at this in terms of long-term, intermediate to long-term, roughly equal kind of low, kind of right in this area here around the 24.45 mark or so. And you can kind of see where that horizontal, if we were to kind of take this and draw a big fat magic marker line across there at about the 20,400 mark, that becomes kind of the support level that this is sitting on, bounced up off of, and you see the strong print to the upside on the RSI. It came very near that lower reversal zone, the top of that 30% level, and very near the 50 or the 200 period simple moving average. And there was some buying pressure coming in and pushing prices higher. But for me, from a technical analysis perspective, using technical analysis as part of this discussion, one of the concepts that technical analysis suggests is that when we have a big candlestick, whether it's red or green, the midpoint of that candle oftentimes acts as a level of support or resistance. So I'm going to draw my line here kind of at the midpoint of yesterday's big candle. And you notice a couple of things here with that midpoint of yesterday's candle. It was support on Tuesday. It was support on Wednesday. On Thursday, it was the middle of that big candle that pushed down through it. And guess where it was today? It was resistance. As strong as this momentum move was, as strong as this bounce was up off of the bottom, and as strong as that RSI push was down here at the bottom, it didn't break through this support resistance kind of toggle point, right? Pat Mullally and I used to refer to this as a technical toggle point. Above that level, that becomes significantly more bullish. Below that level, or holding below that resistance level, that becomes consistently more bearish if it stays below that level, right? So that's kind of where we are here at this particular point, right? But yeah, absolutely. I mean, if Leon asks the question, well, wait a second, what about the weekly chart? Are we just holding that kind of overall channel? And I think we can make that argument. Yeah, for sure. Let me grab my big magic marker, and we'll draw that kind of level in here right about there. And you can see where that is. And if we change this to weekly candles, we'll see if that area kind of holds up. We'll kind of pop this back into our weekly. I got to delete that line, though, because it's in the wrong place. But so let's take that off. But we'll move this back, and we'll say, hey, there's that weekly channel. Same thing, right? I mean, we're just drawing that level there. We could argue perhaps also that on the weekly candle, there's that upward moving channel that's going on. And I think that kind of becomes the characteristic here, right? If this is weekly, if these are weekly candles, that weekly channel still intact. the trend hasn't significantly changed here, even though it's come back down and it's testing. Now, if it breaks the 200 period moving average, then from a technical analysis perspective, things, I think, change. That becomes a more significant bearish signal. But we're not there yet. We saw a bounce up off of that level. So until next week, or until that changes, we've got things coming up next week. We've got non-farm payrolls. We've got more earnings announcements. Not a lot, because we're kind of back at the end of that. But next week, we've got ISM numbers. We've got factory orders. We've got the ADP precursor to non-farm payrolls. All of those things are going to have a potential impact on the market as a whole, right? And that becomes a good question, right? So Fibonacci-wise, good idea, Wiley. So let's pop this in here. I'm going to grab my Fibonacci retracement, and I'm going to actually, you know what I'm going to do? I'm going to take this kind of support level. Actually, I'm going to come all the way back to this August low in this context. So I'm going to come off of that top, and I'm going to draw this down to that significant low here, because that really becomes kind of the challenge. We're not down 50%, right? I mean, we see this maybe a potential for a double top, but the double top symmetrical support puts it right back down about this 50% level. That 50% level, in this particular case, that might even be the more significant area. And you see that that's probably going to be kind of the confluence of where that 200 period moving average is if price continues to move to the downside, but we're not quite there yet. I'll show you some resources on other ways to use the Fibonacci tool, but that's one way that we could draw that line in there, or draw those ideas. And remember, Fibonacci's, they're not a magic wand. They're not a magic ruler. They're simply a ruler graduated in Fibonacci ratios. So they don't tell us anything magical. They just confirm levels of potential support and resistance that might already be there. Now let's take a look at the Russell 2000, which arguably is kind of in this particular case, one of these things is not like the other scenario here, right? Because in the Russell 2000, as we talked about last week, the Russell continuing to push to the downside. This is small caps. And we talked about kind of the interesting thing going on here with small caps, in that small caps tend to be, the Russell tends to be more interest rate sensitive. So I'm going to put on here that study like we did last week. I'm going to do a comparison study, and I'm going to compare this with /10Y. Now, remember, I'm using the futures market for the 10-year interest rate. We're not looking at this as a trading instrument. We're not trading 10Y. If you're going to trade futures, and there are lots of resources for learning how to trade futures. I teach a webcast on Tuesday mornings on trading futures. Remember that they're highly leveraged products. They're not suitable for all investors, and they require separate trading authorization. So we're just looking at this as a measurement of the market. And we can see that yields have continued to fall, including today, right? And we see that push to the downside in yields. Yields down ought to be lifting the Russell 2000. Normally, it moves in that oppositional correlation, right? And we can see that. We've seen that before. We see that correlation here, that oppositional correlation, where the Russell was down on the 200 and rates started to fall and the Russell rallied. Now, rates have been falling. The Russell's been falling right alongside them until today. So maybe we're starting to see that correlation coming back into that inverse. And if we get a crossover between those two, maybe we see that move back in the opposite direction. Okay. So this pushed briefly down into that oversold range on the RSI, suggesting that there was some movement to the downside. And that little bit of a rally back up, we see that lower shadow to the downside, and a move back to the upside. But nevertheless, this has broken below the 200 period moving average. This becomes a more significant move. And this week was really the week that let this move below that 200 period moving average. So a bit more bearish perspective here. A couple of other things going on, because I know we want to talk about some individual symbols, but over the course of this week, here's what we had. We had tech stock volatility, which led to volatility in the not so much the S&P, but certainly in the NASDAQ, and also here in the Russell 2000. We saw tariff talk coming back to the forefront. We see geopolitical tensions, including today, kind of coming back and battling and butting heads, if you will. And we see some key economic indicators, namely things like consumer confidence came out this week. It was down 9.8% from the January numbers, right? And that would suggest, and the expectation was at 67.8. We were at 64.7. It was expected to be down, but it was down more than expected, which suggests, again, maybe retail, which has been the backbone of some of these consumer discretionary spends. We talked about this last week. Not quite there, not seeing the same push. We saw durable goods orders down a little bit. We saw pending home sales down, Case-Shiller prices down, new home sales down, consumer credit delinquencies starting to tick back up a little bit. So all of these things kind of coming to this discussion, right? And maybe you're right, Trade and Grow. Maybe this was a possible, dead cat bounce, to use that kind of market term, right? The idea being that anything pushes down or drops hard enough and fast enough, it's going to bounce, including a dead cat, which is a macabre way to put it. But it's, it's illustrative of the idea here that sometimes buyers will step in and push things back up. So that's the major market index kind of overview. Let's take a look at a couple of other areas that have changed in the last couple of days. So I'm going to pop back over here to this grid. And this is the grid, my yield versus SPX. And the first thing I want to look at in this particular grid is this view right here, which is the volatility index, the VIX. And I've drawn this kind of symmetrical triangle on the VIX. And we see that VIX kind of bled off today. It was up a little bit higher to start. We saw that move to the upside in volatility. This is the expression of volatility in the options market. And it's oftentimes used as kind of the fear gauge, if you will, for the market. Tends to be reactionary more than proactive. And we see it spiking a little bit and then coming off, which is the scenario often when the market rallies hard after a big move to the downside is you see a quick bleed off in volatility. We've seen it before. Every time the VIX spikes, that spike does not stay for a long time. And those spikes tend to become normalized over time. It's like the first time you see a horror movie, you get really scared and you get a big spike in that volatility, right? Then you see it again, and it's still scary, but not so much this time because you kind of know what's happening. The third time you see it, okay, I know what's coming. I'm not responding. I'm not getting scared. So we get a little bit of volatility response, but not much, and now it's starting to bleed off. So volatility is still above average, but not huge. But volatility leads to opportunity when it comes to market movement because volatility allows traders who are seeking premium, who are selling premium in the option market, to realize perhaps more premium. It also allows for what's oftentimes referred to as more two-sided trading, meaning there are buyers and sellers pushing prices around. So volatility is an equivalent to movement. Implied volatility, which is what the VIX is an equivalent to expected or potential movement. And so we can kind of see that that's bleeding off here a little bit. Now, the next thing that I have here in this comparison is going back to a question that Richard asked me or Kevin, excuse me. This is the SPX versus the SPX equal weight. So remember, SPX is a cap-weighted index. The components weighting within the index is relative to their market capitalization. This changes it to an equal weight. So it takes out the influence of the largest and the smallest in that mix and normalizes everything. And those are moving almost in lockstep. There's not a lot of oppositional movement here. That correlation coming back to almost that one-to-one correlation. SPX equal weight lacking behind SPX cap weighted, which suggests maybe there's a little bit more coming back into some of that technology leadership, especially today, this afternoon, after a number of those, NVIDIA, Meta, and others released earnings. Palantir this week releasing earnings. So maybe a little bit of leadership coming back into the SPX from those tech names, at least today. And then the last thing I want to look at is the S&P versus the 10-year. And now you can see, while that correlation had been down near that -1, they were kind of moving in opposition a little bit. They've resumed kind of that lockstep back in that one-to-one correlation. In fact, the highest level of correlation that we've seen between yields and stocks over the course of the last year occurred yesterday, and now seeing that correlation dropping off a little bit as stocks rallied and yields continued to drop. Now, this would suggest potentially, and again, going along with the idea of a bullish or kind of a maybe dead cat potential bounce, this would suggest the downward movement in the 10Y would suggest that maybe there is still money flowing into bonds, because this bond yield, as expressed by the /10Y, suggests that bond buying is still taking place. Bond prices go up, yields go down. It's a teeter-totter. So when buyers are stepping in and buying bonds for safe haven reasons, for protection reasons, for, I hesitate to say it, the full faith and credit of the U.S. government? Question mark? Bond yields go down. So there is that, right? And we see that kind of oppositional movement resuming a little bit, just a little bit there. Now, the other thing I want to look at really quick and kind of getting to this is the relationship of the SPX and its components. So individual stocks, we're not going to break it down into sectors yet. I will do that in just a second. But what I want to do is I want to look at a grid here that is the SPX relative to moving averages. So this is the S&P 500 and the percentage of stocks within the S&P 500 that are above their respective moving averages. 3 moving averages they use here in this particular case, right? So the percentage of stocks in the SPX above the 200 period moving average went up a little bit. It's been down, but it's at about 10% of the components within the SPX above their 200 period moving average. Starting to turn back up a little bit, because you can see where it had been. The highest that had been was earlier last year at about 18% of the components of the SPX above their 200 period moving average, right? Now, about the same number, about 10, almost 11% of the components of the SPX above their 50 period simple moving average. But a lower number below, or excuse me, in this particular case, only about 6%, 6.5% above the 100 period moving average. What that suggests to me is that in a lot of these cases, these companies, the stocks that have been pushed to the downside, pushed below their 200 period moving average, the proximity of the number above the 50 to the number above the 200 suggests to me, from a technical analysis perspective, that there may be a number of stocks that are either at or approaching that golden cross perspective, the 50 period simple moving average crossing from below to above the 200. And for some institutional traders, that golden cross perspective, an intermediate term moving average like the 50 period moving above the 200 period, which is a long-term moving average, is or can be potentially a significant entry signal into long portfolio positions. So as we start to see this occurring, and if we start to see that number significantly ticking above on the 50 period simple moving averages or the percentage above the 50 and the percentage above the 200 starting to move higher. We start to see that number above the 50 moving up. That would suggest that we're starting to see more of those crossovers, those golden crosses happening. We'll see if that occurs in a number of these cases. Now that we got that in place, now that we've kind of taken a look at that, here's what I want to do. I want to pop over really quick to my sector grid. We've looked at this before. This is the sector index grid. I shared this last week. I'll share it again simply because I like you. Really like you guys. You guys are great. You're here. I'm going to pop this over into the chat. Anytime we share anything, remember it is for illustrative and educational purposes only. This is in the description of the webcast. It is not guaranteed as to time or accuracy, but let's jump in to the individual components here of this sector grid. So I'm just going to maximize these cells really quick, and we're going to pop back up to the top of the grid, the top of the order. This is energy. And energy blasting off of that 50-period simple moving average today. A lot of bullishness coming back into energy. We started to see, because of geopolitical tensions, a little bit of risk premium coming back into oil, and that benefits the energy sector, and starting to see that pick back up a little bit here. Materials. Let me grab my label here and bring that over. That kind of drifted off the right-hand side of the chart. Materials picking back up, and a lot of that has to do with energy as well. As energy prices are picking back up, that has an impact on prices for things in the material space that are based on petroleum products, right? Let's take a look quickly at industrials. We talked a lot about industrials last week in the context of the airlines specifically. Industrials moving back up above the 50-period moving average here, suggesting that maybe there's a little bit of a bounce coming in those industrials. We saw some of the manufacturing numbers last week. Coming up next week, we're going to see ISM manufacturing PMI numbers. We're going to see factory orders. Those are going to have an impact on this industrial sector. And then consumer discretionaries continuing to push to the downside. This was the weakest area, at least initially. Now starting to see a little bit of a resurgence, but we saw some of those retail stocks getting hit pretty hard last week. This is consumer staples, and staples seeing a big bounce. We talked about the strength in staples in this particular case. In fact, we looked at Walmart as an example of that. We looked at Johnson & Johnson as an example. Illustrative and educational examples, not recommendations. This is healthcare. I don't know why all my labels got pushed off to the right-hand side. Healthcare starting to see a push to the downside. We saw strength last week, continuation. This was a little bit of a bull flag, kind of right at that resistance level here, that potential for a break to the upside on an inverted head and shoulders type of pattern here. Symmetrical target might be up around that 1779. So some potential to this move if it breaks out above that resistance in the 50-period to moving average turning higher. Boy, every single one of those labels bumped off the back of the chart. So we'll just make sure that we do that every time. Financials was getting hit hard last week. And again, this is interesting. So we talked about the kind of strangeness of that relationship. Rates down, financials down. Now we see rates down, financials up, which is, again, in and of itself, a kind of an interesting perspective, because remember, financials benefit on the loan side, on the revenue side, from cheaper rates in the offering, because they get more customers, right? More mortgages, more credit card customers, more auto loans if rates are lower. But they get hurt if interest rates are lower, because they're not collecting as much and they're not making as much on assets under management. So that's an impact. But we're starting to see financials ticking back here right up against this resistance level in this particular case. And this is information technology. I'm not even going to go out and find, sure I will. I'll go out and find the label. There it is right there. We'll put the label back. We'll come back over here. Biggest weakness today for sure, or yesterday, and then the kind of that gap down and rally. Piercing line, but still kind of that belt hold. Notice it didn't pierce or break up back through the midpoint of yesterday's big red candle. We talked about that concept earlier. This is communication services, and this is your streamers and your telcos. and others, and continued weakness. Again, right up at that midpoint of yesterday's big red candle. Bullish bounce, but not a truly solid breakthrough, breakout bullish bounce yet. This is utilities, interest rate sensitive. And as rates continue to go down, this relationship kind of normalizing itself. Rates down, utilities up. These are interest rate sensitive companies because they borrow for infrastructure costs. And breaking up through the midpoint of yesterday's candle, that could be considered to be a stronger piercing line type of candlestick pattern with some strong movement to the upside. And then real estate. And this is the area where if rates continue to move to the downside, let's grab that comparison here really quickly. We'll add that comparison to /10Y, which is the 10-year yield, which is what governs a lot of mortgages. And as this continues to move to the downside, real estate continuing to rally. You can see this oppositional movement going on here and resuming that negative correlation, which is rates down, real estate segment moving to the upside. All right, cool. Now that we've got that in place, let's look at a couple of the individual names here in the list. I'm going to bring up my single grid, and we're going to take a look here at NVDA. Some of you might be familiar with this particular stock, making that move to the downside. But boy, a far cry from breaking back up above that that midpoint of yesterday's big red candle, kicking back up to the upside, long lower shadow, but doing it perhaps with a lack of momentum. And this could be creating the potential for a head and shoulders type of pattern to the downside. But it broke above this resistance. It broke to almost the midpoint. PLTR, Palantir, big strong move over the course of the last 2 weeks to the downside, down below this horizontal, what was support, now kicking back up and almost back up into the range of yesterday's candle, following a change in tone here on Palantir from that earnings. Let's take a look at a couple of others. Meta kind of holding its support level here, not quite making it back, but not changing the trend significantly. Apple, big bullish hammer-like candle bounce today, potentially. AMZN, making a move back to the upside here. And so we're seeing some strength coming back into some of these stocks. Now, one I wanted to look at, NCLH, Norwegian Cruise Lines. I talked about this earlier in the week on the Schwab Network. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions, which is a separate but affiliated company. The Schwab Network, we had a conversation about this, and we were looking at the potential for this winding up into the earnings announcement. Earnings was good, but the market punishing this on a consumer standpoint. Consumer confidence down doesn't speak well to the likelihood of continued movement in the cruise space, which I suppose is good if you're going on a cruise and it's not, you don't want it as crowded and you want maybe some better deals. Not so great when you're talking about revenue on the part of the cruise lines. So seeing that continued push to the downside, not completely sinking yet, not down to this level of support, but certainly not floating higher yet. All right, let's look over the horizon here really quickly. We're going to go to our Market Watch tab. We're going to go to the calendar, and we're going to look at next week. So we're going to pop this out to next week. We can see some of the things that are coming up. I've mentioned them before: ISM, PMI numbers, factory orders, and then non-farm payrolls on Friday. Maybe the big read on what's going on now with the new administration and things that are happening there. This is going to be for sure and potentially a market moving non-farm payroll number. So something to pay attention to next week is that non-farm payroll number. The other thing we're going to see next week as well is Baker Hughes numbers. Baker Hughes rig counts tell us the state of investment in the energy space. And we've seen 7 rig increases over the last 2 weeks. We start to see more increases week over week over week. That would suggest more infrastructure spend on the part of the energy sector in that drilling and exploration space, which would suggest that potentially energy prices might stay in this kind of Goldilocks sweet spot between about 70 and about $80 a barrel on crude oil. So that's something to pay attention to next week as well. You know what I want to do, though, before we get away from this Friday afternoon and before I turn you guys loose for the weekend, is I want to spend just a minute talking about some additional resources. So I'm going to pop over here really quickly to schwab.com/coaching. And this is perhaps one of the locations that might be beneficial if you want to learn more. If you have some time this weekend, you want to spend some time, join our on-demand and our live webcasts. You can see the calendar right here. You can go to the Trader Talks webcast page if you have not been here already. If you've not subscribed, this is a great place to subscribe. You can search. So I'm going to give you another webcast that might be helpful. Market and sector analysis is a webcast that we teach on Wednesdays. Michael Fairborn, I think, normally teaches this. This is a great discussion and a great way to kind of learn some more of these aspects of intermarket analysis that I take into this discussion today. And then the other thing I want to do is I wanted to point out, as I said, next Friday I'm going to be, and Saturday, I'm going to be in Scottsdale along with Barb Armstrong, Kevin Horner, Ray Kimbrell, Scott Durfee, and we're going to be doing the Technical Analysis and Option Strategies Workshop. There's still room if you want to come and join us, but those are going to be closing fast. So if you want to come see us, you want to come join us, it's at no cost to you. We buy you lunch both days, that kind of stuff. We provide refreshments. Come and join us. Click on this location. So this is schwab.com/events, and you can get to this calendar. But the Technical Analysis and Option Strategies Workshop is designed as a beginner to intermediate type of an event. We take you through the understanding of technical analysis and option basics. We'd love to have you there. After that, we're going to be doing on March 21st and 22nd, an advanced option strategies workshop over 2 days in Schaumburg, Illinois, which I know is not entirely Chicago. It is a suburb, but we'll call it Chicago just in the broader sense. But join us for that. That's going to be 2 days. That's going to be me and Kevin Hinks from the Schwab Network. And then we're going to be in Detroit. We're going to be up north. For those of you who said, hey, we never come to Michigan. We're going to be in Detroit doing the Technical Analysis and Option Strategies Workshop. Sign up for these. Join us for those events. We would love to have you there. Once again, my thanks to Brent Morris for helping out today. My thanks to all of you for being here with me. I hope that you've had a good end of the week. We'll look forward to next week as well. And as I always sign off on Friday afternoons, as I did before in our Wall Street wrap-up, keep your arms and hands inside the right at all times. Hang on and have fun. We'll see you next week. Take care, everybody. Bye-bye.